Our topic today is accounting changes. Uh, and this is our outline for the day. What we're going to do is start with a review of the reporting goals, which is what we're going to, and then we're going to move into a summary of the changes, of different types of changes, and then we'll talk and how they are accounted for differently in broad ways. Next, we're going to talk about changes in accounting principles. And then we'll give an example of how retrospective reporting works. We'll look at disclosures for that. And then we're going to do some more examples. And finally, we'll do a quick review at the end. Let's get started. So, as you probably remember, I think it's chapter 1 or chapter 2 of 330, the original intermediate accounting course. Decision usefulness is the overall goal of financial reporting. And both FASB and the International Accounting Standards Board have agreed that that is comprised of relevance and good, faithful representation. That is, if the numbers are relevant, they're capable of affecting a decision, and they're faithfully represented, then the information should be useful for making a financial decision. So let's talk about what the components of relevance. It must be capable of making a difference in a decision. That is, it has the ability to help us predict. It has the ability to tell us whether we made good decisions in the past, and it's material and large enough to affect a decision. On the other side, faithful representation is complete information that is free from bias and free from error, free from bias being neutral. It means that the numbers and descriptions match what really existed or happened. So it's faithfully reporting what happened. And then there's some enhancing qualities, and the one we're going to be focusing on today is comparability. Information that is measured and reported in a similar manner for different companies is considered comparable across companies. We also want it to be comparable across time for the same company. And so those are sometimes a trade-off between the two. So next, let's talk about a summary of the accounting changes. There are three main types of accounting changes. Change in accounting principle, a change in accounting estimate, and a change in reporting entity. A change in accounting principle is when we change from one GAAP accepted method, or if you're in the IASB world, one accepted method to another. In a change in accounting estimate is where we've revised an estimate that we previously made based upon new information or new experiences. And then we have a change in reporting entity. So each of these, the examples are given over here on the right. For example, a change in accounting principle, we change from methods of inventory costing, or a change from cost method to equity method, or vice versa. Change in accounting estimate is where we change something like depreciation methods, or the useful life, or the residual value, or some sort of estimate related to, say, deferred tax asset valuation allowance, or the allowance for doubtful accounts. And then change in reporting entity is when we consolidate where we previously didn't consolidate, is probably the best example, and vice versa. It's important to recognize that changes in depreciation methods are changes in estimates. In fact, the 4 or 5 methods of depreciation that the book talks about, you'll find that in practice there are lots more that are used by different companies. They just didn't happen to be in the intermediate textbook. And GAAP finds them acceptable as long as they're reasonable and they're applied consistently. Reporting accounting changes and indeed error corrections. there are three approaches. The first approach is retrospective approach. That is, we go back and for all of the comparative years, we assume that that change had been in effect for all prior years. And we make the financial statements appear as if the newly adopted method has been used all along. A modified retrospective approach is where we adjust retained earnings at the beginning of the year and the new standard is only applied to the current period. And that's not used very often. It's usually dictated by a new accounting standard put out by FASB. And third, there's the prospective approach. This is effects of the changes are considered only for looking forward in the current and future years. One great example of that is any kind of change in estimate is going to be accounted for on a prospective approach, only looking at the current and future years. Okay, next let's take a look at changes in accounting principles. Change from one generally accepted accounting principle to another. Often this can be done voluntarily. If, for example, we want to change from LIFO to FIFO or from successful efforts to full cost for depletion and or something that are both acceptable. Accounting choices, once they're made, should be consistently applied from year to year, but sometimes there'll be changing circumstances where we need to change. For example, if everybody else in the industry is using one accounting method and we're not, then we feel the pressure to go along so that our numbers are going to be comparable to theirs. Changes in accounting principles. Let's just think a little bit about why accounting choices, decision makers, that is managers of companies, make these changes. It could affect their management compensation, could affect debt covenants that affect, it could also affect union negotiations. Often when you have union negotiations going on, you don't want to increase income, you want to show lower income so that the pie doesn't look as big and we don't want the union to take a big slice of it. So we want to show something lower. The financial analyst must unravel these different companies and their different financial accounting methods so that they can compare them across firms or across time for the same firm. And then investors and creditors need to try to figure out what was management really trying to do? What are their hidden motivations when they switch or sometimes don't switch from one method to another? So from the decision maker's point of view, they see the world as a very dynamic place. There's wars and there's famines and there's wildfires and there's all kinds of things that are affecting the international market that they live in. But what they're trying to present is very smooth earnings and financial statements that we are under control. It doesn't mean that they always want higher earnings. They just want to show we've got this company under control, even though the world is kind of going crazy out there. We're under control. And that doesn't always mean that managers want higher income. So let's just take a check here. Which of the following is not a change in principle? A change from the LIFO to the average costing method that are both GAAP? I would say yes, that is a change in principle. A change in the useful life of a depreciable asset? That is a change in estimate, not an accounting change. And so I think B is going to be the correct answer here. Oops, sorry about that. Yeah, B is going to be the correct answer here. A little timing thing going on. A change to implement a new FASB standard, that is considered a change from one GAAP method to another, and a change from the equity method to the cost it is also a change in accounting principles, not an estimate. So now let's talk about how does retrospective reporting work. Changes that are first we're going to talk about what changes, what is retrospective reporting, and then when does it apply. It applies when there are changes in the reporting entity and when there are changes from one GAAP method to another. A change in reporting entity. Here we're going to change from reporting as one type of entity to another type of entity. This occurs as a result of presenting consolidated financial statements in a situation where we prior didn't have consolidated financial statements and we were reporting them separately. But now we consider them as under one common control and show consolidated financial statements. We change the specific companies that constitute the group. We add in a company because we gain some ownership in it. Then we have a change in reporting entity, change in accounting rules that affect what entities are included, or we acquire another company or divest from another company. Those are examples of changes in reporting entity. And these are accounted for as if the new reporting entity existed in those prior periods. So if you are reporting all of the 3 years in a row, say 26, 25, and 24, and you had a change that occurred in 26, you would go back and restate 25 and 24 as if that had occurred all along, and the beginning balance sheet balances would be restated as well. You should have a disclosure note that describes the nature of the change and explains what the reason was that caused the change. Let's talk about LIFO. LIFO is last in, first out. And during inflation, LIFO produces larger cost of goods sold and smaller gross profit and pre-tax profit. LIFO is the one accounting method that we have required conformity between book and tax. That is, if you choose LIFO for your tax return, the Internal Revenue Code says you must also use it for your GAAP financial statements. Importantly, LIFO is only used in the United States. Most of the rest of the world does not use LIFO. And so those are some things to consider as we become an international community and international capital markets and international competition. The use of LIFO creates a very special circumstance. And many companies do not want to be compared with a FIFO company just because it saves tax. And, it's a very interesting situation, but they often will avoid using LIFO to be comparable with other companies that are not American. So here's an example of a voluntary change in accounting principles that's applied retrospectively. In this case, Air Products Corporation used the LIFO inventory system method. At the beginning of 2024, however, they decide to change to the FIFO method. Maybe all of their competitors are using FIFO, so they want to do that. And what they do is they report and they show you, okay, this is what cost of goods sold would have been under LIFO for all prior years before 2022. And then for these 22, 23, and 24, remember, last in, first out has higher cost of goods sold when prices are rising, as they normally do. Not in all industries and all times, but normally our costs are going up. And then Air Parts has paid dividends of $40 million each year since 2017. Its income tax rate is 25%, and its retained earnings at the beginning of 2022 was $700 million. and inventory was 500 million. Okay, and that was inventory that was reported under the LIFO method, the old way. Now, the effect on the balance sheet, well, and is in terms of retained earnings, we had $300 difference in all of the prior years between LIFO and FIFO in cost of goods sold. So cost of goods sold is lower under FIFO than it would be under LIFO. And as a result, if we have net income that would have been lower net of the $75 tax savings. And so we would have lower retained earnings. And by switching to FIFO, we're going to have higher retained earnings. Okay. And in each of these years, by switching from LIFO to FIFO, we have lower cost of goods sold and higher gross profit. As a result, we're going to have higher gross profit and lower cost of goods sold, okay, in each of those three years. Okay, this is the cumulative effect. This is the annual effect. The cumulative effect is taking the 300 cost of goods sold that was up through for all prior years, plus the 40 from that year, and that's 340, plus another 44 from 23, that's 384, plus another 48, it makes 432. So what we need to do is we need to revise the financial statements as if we've been using the newly adopted accounting method, FIFO, all along. Remember that we have, under FIFO, we have 360, 365, and 370 of cost of goods sold. We want to restate as if we've been using that all along, and we have revised income tax expense. Notice that we're not necessarily going to pay higher income tax until we change it for 2024 and going forward, but we're still going to have a higher tax expense for GAAP purposes. It's a deferred tax issue. The beginning retained earnings that I stated earlier was $700. But then we're going to add to that the cumulative difference in FIFO to LIFO, which was 300. That is reduced by the tax effect of 25%. So it's 1 minus 0.25, or 0.75 times the 300 is 225 of additional retained earnings. It was 700, but if we had been using FIFO all along, we would have had another $300 of income because cost of goods sold would have been lower for those years. But then, of course, if we had another $300 of income across all those prior years, we would have additional tax. It's a accrual-based tax. It's not a cash tax, but we would have had that. Okay. Then we adjust each of these years as if the dividends remain the same, but we're going to use FIFO in all 3 years. And so that's our retained earnings balance. We adjust the accounts, and ultimately we have an increase in or a reduction in cost of goods sold over all years from before 2024. And that's going to be an increase. If it's not in cost of goods sold, it's in inventory. So we're going to debit inventory. We're going to recognize that if we have this additional 384 of income across all these years, we at an average tax rate of 25%, we should have an income tax payable of 96, and that's going to be due because suddenly we're switching to FIFO, and the IRS is going to want their share of that. We're going to have to come up with that in tax, and we're going to have retained earnings, and that's going to be the difference, or the 75%, 1 minus 25% of the increase in inventory, and that constitutes increased pre-tax earnings. Okay, so that is the journal entry that we need to make on January 1st, but we report our comparative financial statements for 22 and 23 as if we have been using FIFO all along. So, concept check. Big merchandisers changed from the FIFO method of costing inventory to the weighted average method during 2024. When reported in the 2024 comparative financial statements, the 2023 inventory amount will be, in this case, what we don't know, the difference between FIFO and average cost. Often, inventories will go down if you make that switch, but we don't know for sure how prices changed during 2023 and before. So I think C is going to be the best answer here. It will be restated to the balance it would have been if we had been using weighted average all along. I think in general, that would mean that inventory would go down, likely go down if you're using the average cost method, but you have to look at the actual data. All right, now let's talk about disclosures. Making an accounting change, and that affects our consistency across time. So we need to, in the first set of financial statements after the change, justify why we're making that change. We need to explain why the change was needed, as well as its effects on the items that are not reported on the face of the primary financial statements. We need to point out that the comparative information has been revised. So we have gone back, and if we're showing 3 years, we've revised those 3 years. And then we need to show, here's what the earnings per share effect was of making this change. And so we need to, for each and every period in which there's a change and we're presenting comparative financial statements. So you've got earnings per share as reported, and then the effect, and this is the revised earnings per share using the new approach. Here's an example of a change in inventory method. They are changing for inventory from the lower of cost or market using the retail method to the weighted average cost of method in accordance with GAAP. So both of these were GAAP. All periods have been retroactively adjusted to reflect the new accounting method, weighted average. They believe that accounting under the weighted average method is preferable as it aligns with our focus on realized selling margin and improves the comparability with our competitors. It'll improve matching with cost of goods sold with the related sales. And then here is the effect of it on inventory and an increase in retained earnings. And the difference here is income taxes. Some more examples just to take a look. Sometimes FASB allows or even requires a modified retrospective approach. If it is a modified retrospective approach, usually that it's applied to the adoption period only, but we go back and adjust the balance of retained earnings at the beginning to capture the cumulative effects of the prior periods without actually changing the numbers in each of the prior years. So we're essentially just changing the beginning balance sheet, but we're not going back to the 1, 2, or 3 prior years that we're reporting on a comparative basis. Sometimes it's not possible to report a change retrospectively, so the new method is simply applied prospectively. And the best example is any change to LIFO is considered impractical, and therefore we're going to consider it prospective only. So change from FIFO to LIFO, and this change is preferable. It's the cumulative effect on the change from the FIFO to LIFO method is not determinable because they weren't keeping track of it on a LIFO basis. So they're only going to do it prospectively, and that is the way GAAP normally works. If any change to LIFO is considered a prospective change. If it's impractical to determine periods effects or a cumulative effect, then in that case we use the prospective approach. Okay, so any change to LIFO, now changing away from LIFO is a different story. That's considered retrospective. But any change to LIFO is accounted for prospectively. Any other accounting standard that specifically requires prospective accounting. So if you get a new accounting standard, it may say, we're only going to apply this going forward. Then you have to follow that. But there's one more likely to occur, and that's any change to LIFO. Okay, a change in accounting principle that usually should not be reported by revising the financial statements of prior periods is a change, the weighted average to FIFO, that's GAAP to GAAP, and it can be calculated relatively easy. That's not it. The weighted average to the LIFO method, that's the one we're looking at because it's to LIFO, and so B is going to be the correct answer. Notice that D is not correct because LIFO to the weighted average is shifting away from LIFO, and that one we consider retrospect. But anything going to LIFO is prospective. Which of the following is not a change in accounting principle usually accounted for retrospectively? And the answer here is changes in estimates. And by definition, any change related to an accounting method for depreciation, that is, sum of the year's digits to double declining balance, change in the number of years, the change in the residual value, a change in the method, all of those things are accounted for prospectively. Now, if there was an error and we should have known better in a prior year, that's a different story, and we'll deal with that in the error section coming up. Changes in accounting estimates are defined as a revision of an estimate that results from new information or new experience. They are accounted for prospectively. And the disclosure note should describe the effect of the change in the estimate on income from continuing operations, net income, and related per share amounts for the current period. And I would only say that those latter disclosures are for very substantial amounts. Those changes in estimates that are relatively small are not highlighted in footnotes. Okay, here's an example of a change in estimate. The company determined that as a result of actions taken to increase its preventive maintenance and programs initiated with its to increase the quality of the products, actual lives for certain assets were generally longer than the useful lives for depreciation purposes. Therefore, the company extended the estimated useful lives, and it explains the effect of this. It was a substantial amount. I would say that this is depending on the relative size of the company, and I know Owens Corning to be a relatively large company. This would be in a gray area as to whether it's necessary to disclose because changes in estimates are not always disclosed like this one is. The prospective approach usually is required for the best answer here is B, a change in estimate. Changes in reporting entity, we go back and account as if the new reporting entity has been that way the whole time. A change in accounting principle, other than a change to LIFO, is going to be a retrospective. And a correction of an error, we always go back and restate those. We'll talk about that next time. Here's another example. Lamont Communications has amortized a patent on a straight line basis since it was acquired at the beginning of 2021 at a cost of $50 million. Management decided that the benefits from the patent would be received over a total of 8 years rather than the 20-year legal life. Lamont's 2024 financial statements should include, okay, so they were originally taking over 20 years, which would be $2.5 million a year. And it was acquired at the beginning of 2021. And now, the cumulative amortization at the end of 2024 is $16 million. That's comprised of 3 years amortization plus 1 year of amortization at 8.5 million. So we've got the original amortization, 50 minus 3 years at 2.5 is 42.5. And we've got 5 years left. We're going to take 42.5 divided by 5, and that's going to get us 42.5, 8.5 million. 8.5 million plus the 7.5 million is going to be 16 million total. And we just subtract that 16 million from the 50 million, and we get our accumulated amortization of 16 million and a book value of 34 million. So a patent balance of 34 million is the correct answer here. You have to work through it. And what you do is you go back and calculate how much amortization is in each year. And we are only looking forward and revising 2024 because we made the change in 2024. Okay, the change was, here's an example of a change in reporting entity. In this particular case, it says Hartford Life changed its reporting entity structure to contribute certain wholly owned subsidiaries, including the European insurance operations, to the company. The contribution of subsidiaries was affected to more closely align servicing entities with the writing company issuing the business. The change in reporting entity was retrospectively applied to the financial statements of the company for all periods presented. So we changed the reporting entity and we're reporting the financial statements as if the reporting entity had been that way in all comparative years. And then we explain what was the effect on stockholders' equity of approximately $1.3 billion. So which of the following constitutes a change in reporting entity? A change in product line? Probably not. A company reports a loss after reporting income for 5 consecutive years. Converts from a simple capital structure to a complex one that has a preferred stock, for example. Or D, they acquire ownership of Outdoors Unlimited, and there's a change in reporting entity. And we're going to go back and restate as if we'd owned Outdoors Unlimited all along. So let's review. We need to be able to explain the types of accounting changes and explain the types of accounting for these changes. So these are the types of accounting changes: a change in accounting principle, a change in accounting estimate, and a change in reporting entity. There are three approaches. The retrospective approach, which is done generally when there's a change from one acceptable method to another method, or there's a change in reporting entity. That's the retrospective. When we go back and restate the prior years that are being reported as if that new approach had been used all along. There's a modified retrospective approach that is sometimes allowed when there's a new accounting standard that comes out, and it says you just have to change the current year and revise the beginning retained earnings, the beginning balance sheet, as if you'd been using the new approach all along. And then there's the prospective approach, and this is effects of changes are reflected in the financial statements only for this year and for going forward. Any change to LIFO from another method is going to be done prospective. Any change in depreciation method or number of years or salvage value, something like that related to depreciation is going to be done prospective. Next time we'll come back and we'll talk about accounting for errors. There you have it. I hope that helps you.